Three stocks that I'm buying right now. And unlike a lot of other YouTubers, I'm going to show you my cost basis on every single stock that I go over, as well as how much am I up and how much am I down on each one, and just my overall thoughts on why I'm so bullish on the stocks that I'm buying right here. And the first one is just such a steal right now. It's literally free money for a few reasons. We're going to go into the financials later, but I want to quickly talk about some other things. But they're trading at a 14% free cash flow yield and 11% earnings yield, which we'll talk about all this later. First stock we're actually going to be going over is ticker symbol PERI, and all I ask in return is that you drop a like on the video and subscribe if you're new if you want to watch along my journey. And if you want to see my stock portfolio updates, because this portfolio right here, once I buy a stock in here, I will never sell it no matter what. But anyway, let me show you why I'm so bullish on Perion Network. So like I said, they're trading at a free cash flow yield of over 14%. So that means they make 14% of their market cap in free cash flow every single year. And let's actually look at that. Their market cap is $1.02 billion, as we can see in the top right. And if we look on the left-hand side, we can see their PE trailing 12 months and their PE forward ratio, which uses their 2024 numbers. So based off their 2024 guidance, which they just gave, they're trading right now at a 7.64 times net income, which is just absolutely crazy. That's so cheap right now. And it's not like they're losing money. Let me give you another fun fact. They are debt free. So if we head over to the balance sheet right here, these liabilities aren't actually debt, and they're net income positive, as we can see. Now, the stock has been getting hit because of this growth rate right here. Look at the year-over-year net income growth. It's only up 1.87%. But if we head over here, or let's look at the free cash flow per share, because this includes stock-based compensation. And they actually haven't been doing that much stock-based compensation. And they actually just announced a $50 million stock buyback program. And if you're like, well, $50 million isn't that much. Well, it is when your market cap is $1 billion. That's 5% of all your shares. And if you're like, well, won't that cost them a lot? No, because they literally made $50 million right here in free cash flow in the most recent quarter. So that's another reason why I'm super bullish. We can go to their diluted weighted average shares. So you're only been diluted 2% year over year. And the growth rate, of course, was a lot more than that. But if we go to their total debt, like I said, this company is debt-free, and a lot of companies are actually being hurt by higher interest rates. Well, this company right here, because they have $187 million of cash, they're buying these 1 to 3 week treasury bills. And look at this, they made $6.26 million in pure free cash flow that they earn from cash on their cash. That's because of the high rates. So because of the high interest rate environment, this company is just making so much free cash flow. And now they can use this to buy stock buybacks because their stock price has been depressed so much. If we go to their 5-year chart, it looks amazing. Their 5-year returns are very similar to Tesla. But the market cap is $1 billion and the free cash flow yield is, let me show you actually. So that way, if you don't believe me, we're on this website right here. The free cash flow yield is 14.69%. And the earnings yield, which is net income, so they make 11.15% of their net income, or of their market cap in net income every single year. So that's why it's just such a good deal right now, in my opinion, not financial advice. And if you're interested in these other ratios like the PEG ratio or the price to free cash flow ratio, these are also just super cheap. You can see all the metrics right here. All right, the next stock that I think is an absolute steal right now is ticker symbol NET or Cloudflare. And did you know that 10% of all internet traffic in one way or another actually goes through Cloudflare? But yeah, I've been picking up shares of this company over the past couple months. And earnings was really good. Check that out. They went from, $86 a share way up to 116, but now they're chilling at $95 basically, and I think that's a really good deal. So let's actually look at this. So this one is not like Perion. They are not net income positive. So let me show you why they're still a really good deal right now, because a lot of investors make that mistake. They're like, well, how is their market cap 32 billion, but they're losing so much net income? Well, let me show you this. It's actually the projected growth rate of the company. And if we go to the cash flow per share, they're actually growing their cash flow per share like crazy. And if we compare the cash flow per share from 2019, we can see that they are actually way more profitable than they were back then. But anyway, let me show you the total revenue growth rate here at the very bottom. So check this out. It's 31%, and it's been over 30% every single quarter. Like, look at this. Right now it's 362 million. And if we just scroll out just to 2019, they were just making 60 to or always less than $100 million. And if we head over here to their assets to liabilities ratio, that's the orange number there at the bottom. It's actually gone down, and the assets have also grown. So that's a good sign. But anyway, this is the number we really want to look at right here. So you see how it's up 9.37% year over year, and the cash flow per share is up only 6.93%. That's because they also dilute you as a shareholder. So these year-over-year growth numbers should be the same for cash flow per share and the operating cash flow down here. But that's because of the stock-based compensation. So that's why if we head over here to the total common shares outstanding, you actually have been diluted 2.26% year over year, but that's not that big of a deal. But if we go to their total long-term debt, it's actually down 10.6% from 1 year ago. So they only have $1.2 billion of debt. So that's good to see. All right, so yeah, that was Cloudflare. I now want to talk about another company that just reported amazing earnings, and that is DocuSign, ticker symbol DOCU. Now, I haven't really been buying this company later, and I really regret not buying this under $50, but I'm committed now. If this stock goes under $50 again, I will absolutely be buying DocuSign, and if they go under $50 before the next earnings report. So let's actually check this out. I want to show you why the earnings on DocuSign were just so freaking good. So look at this. Here's their net income per share. Obviously, look at the growth rate at the very bottom. They used to be net income negative, and they just went to profitability. So that's so good to see. Like, look at this. 2020, they were losing $50 million a quarter in net income. Now they're finally net income positive. When if we go to their total revenue, you think DocuSign would stop growing after 2020, like that was their main thing. No, their total revenue is at all-time highs, and it's still growing 8% year over year. So that's still a really good sign. So the growth story for DocuSign isn't over. But check this out. This is the super impressive part. Look at their assets to liabilities ratio. From quarter to quarter, it went from 71% to 61%. And if we look at it from year over year, it went from 79 to 61. So what happened there? They are finally debt free. They paid off all their debt. So I'll actually show you that later, but this is even more impressive. Their cash flow is down here. It's up 100% year over year. Well over $200 million average a quarter easily. And if we scroll back, that's well above what it was in 2020 and 2021. So right now they literally are the most profitable they've ever been, nearly 100% growth rate. So let me show you more of their financials, because this is another company that benefits from high interest rates. So they just paid off $689 million worth of debt, so they're now completely debt free. And if we go to their cash on hand, their cash went down a bunch. It's still up year over year, but quarter over quarter, their cash fell a bunch because they just paid off the debt. But anyway, their $800 million of cash made them an interest $19.81 million, which is absolutely crazy. $20 million in free cash flow just on your cash. And if we go to their total common shares outstanding, you have still been diluted 1% year over year. So a lot of the bears talk about this stock that they have an issue with stock-based compensation, and now they're starting to fix it by buying back some of their own stock. And to be honest with you, their 100% growth rate in free cash flow and total revenue growth of 8% plus and net income growth as well, being diluted 1% year over year, and that's what it's been every single quarter. You've only been diluted 1% year over year. I think it's very sustainable. That's why I really love DocuSign, and I think anything under $50 for this stock is an absolute steal, because look at this sucker. It was once over $300 a share, which is absolutely insanity. And another honorable mention of a stock I'm actually buying the dip on is Public Storage right now. I've committed to never selling these 10 shares that I just bought for at least 5 years minimum. And I was literally just picking up these shares. This one is a REIT and a pretty high yielder of 4.3%. But yo, thank you guys so much for watching. For real, it would really help me out if you dropped a like for me. And if you leave a comment, I'll respond to every single comment, no matter what. And subscribe if you like my content. I'm very transparent, and there's no sponsor, no courses. Although if you want to download Webull, the app I use to, do all this analysis. I'll have an affiliate link in the description. But besides that, have a great rest of your day, guys.